Hello, everybody. It's your boy, Chicago Sean McLaughlin. It's Sunday, March 14th, 2021. I'm recording here in live from Colorado, snowy Colorado. If I look out my window, I've got about 2 feet of snow out there, and it's still coming down. Good times. I'm not going to be doing any video this time. I'm just going to be sharing my screen with you. Hope that's okay. I got a face for radio, as you all know who've been watching my videos. But I have a couple points I want to discuss this weekend. The first thing I want to discuss is stop losses and honoring stop losses. I'm actually going to flip my screen over here to my Thinkorswim platform here. So I want to talk about Draftkings. This is a trade that I'm currently in. I'm long a bull call spread, but the structure of the trade that I'm in is not really that important. What is important is what happened last Friday and then this past Monday morning. Now you'll notice on my chart here, you can see I've got this level highlighted, this 60 level, okay? So when I put my trade on, put the trade on somewhere around here, bullish bet, stock looked good for about 2 days and then boom, hit with a pretty nasty 3-day sell-off, 4-day sell-off. Well, going into the trade, my stop loss level was 60. And oftentimes when I put on a defined risk trade like this, okay, meaning I know the most I could lose up front and I'm comfortable with that loss, I accept that loss up front. It's a mindset, right? Like you have to know that you have the very realistic possibility of losing 100% of your capital on any one defined risk trade. The trick is to size those trades such that if you were to take that 100% loss, it's not really going to be that big of a deal for your portfolio. For me, a good rule of thumb, I don't want to risk more than 2% of my capital on any one trade. Typically, I'll do as little as 1%. Okay, I'm not trying to have one trade make my whole portfolio. I want to be able to put on a lot of different trades, a lot of small trades, and have my process be the winner over the long run. So anyway, with DraftKings, 60 was my stop loss level. Now you'll notice here, this is Friday, March 8th, so a little over a week ago. It had a nasty intraday sell-off. You can see here, the stock traded as low as almost $54 a share. Okay. Now a question that came in to me from somebody was, okay, I know you like to watch for the closing price, and that's what I do. When I have a stop loss level, I'm looking at the closing price. All I care about is the closing price. That's the most important price of the day. All right. So the question came in, he was wondering, like, how do you sit through this sell-off when it sells off way below your stop loss level? You know, your stop loss is at 60, but if things trading at 55, like, how do you not just, jump out the window and bail on the position when it's getting crushed like that? And my answer was, number one, I'm waiting for the closing price. And I know that's hard when a stock is selling off. But number two, and the real reason why I'm able to do that is because of the defined risk nature of the trade. Whether you're just long calls, or in my case, long a bull call spread, I know the most I can lose, and I've already accepted that up front, like I said just a moment ago. So when DraftKings is selling off intraday here on Friday, yeah, that sucks, and I'm watching my P&L just go down, 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 and it sucks. It's no fun, but there's no reason to panic, because I've already accepted that 100% loss on that position in the worst case scenario, okay? Now, the worst case scenario doesn't happen as often as you might think, but we have to be prepared for it. So while we were selling off on that Friday, I held fast to my position and didn't do anything. Now, the next thing that's important is the stock did in fact close below 60, just a touch below 60. The closing price was exactly $59.60. So according to my rules, the stock closed below 60. So on the next trading day, which would have been Monday, my plan is to exit the position at or near the open. Okay. Now, a curious thing happened, and this is the caveat of stop loss orders, at least for me, is that come Monday morning when the stock opened, the stock gapped higher. It actually opened at 60.85. So above my stop loss level. When it trades above my stop loss level, again, and it holds there. It briefly, just for a speck of time, traded back below 60, but it immediately bounced, and the stock traded above 60 all day long. Well, in the situation like that, I basically just hit the reset button and say, all right, well, stock just earned itself another day. I'll reestablish my 60 stop loss level and see if it closes below there again. And as you can see, the stock just whipsawed back up and is now back at all-time highs. Now, did I know the stock was going to, immediately bounce back? Of course not. And in all honesty, when a stock closes below the level and then gaps above it the next day, oftentimes I just bought myself a few more days. Eventually the stock then just, gives up the ghost a little bit later. And all I really did was just waste time, and it ended up costing me a little bit of money. I'm now getting out at an even worse price than I could have got out the first day. That happens more times than not. But every so often, the trade ends up working. And this was just a little shakeout on its way to higher and higher gains. So I wanted to just show this example and let you know that, when you see a stock trading below your stop loss level, if you're waiting for the closing price like I do, if you have a defined risk trade, there's no reason to panic. That's why we size our positions the way we do. That's why we don't risk more than 1 or 2% of our capital in any one trade. Because if we lose that 100%, it's just another day. It's just another loss. No big deal. That's what gives me the strength to sit through these whipsaws. All right, so with that out of the way, the next thing I want to talk about, this is just a little brainstorm I've been having this weekend. Thinking about some interesting ways to get into some long gamma trades, without having to pick a direction. And I've been thinking about reverse calendar spreads. Now, for those of you who are familiar with a typical calendar spread that people typically put on, a calendar spread is where you buy a long option in a back month, let's say 2 to 3 months out, and you sell a short option at the same strike in a nearer expiration. So for example, today is March 14th. If I was putting on a typical calendar spread today, I might sell let's pull up a different stock here for a sec. Let's pull up, Apple. Everybody knows Apple. If I was looking to put on a calendar spread, I might say, all right, I'm going to sell the April 16, 270 or 120 calls, and I'll buy the June 120 calls. And you can see here, the cost would be a debit, $3.70. That's the most I could lose in the trade. And the thinking here is, if I was putting on this calendar spread, that I want Apple to just kind of sit where it is, do nothing, have these short options decay away in value. They will decay away faster than the long options will, and that will ultimately yield a profit in the trade. As long as Apple stays, in or around $120, around that strike price, then I will be able to close this spread for a profit. That's a typical calendar spread. That's what most people do. Now, a reverse calendar spread is where you basically turn that around. I just hit the swap here. Now I'm buying the nearer option and selling the back month. Well, what does that do? Well, that actually flips the risk reward parameters upside down. So let's go back to that other stock just because I have it all set up here. Let me go to NEO. Oops, I can't type. There we go, NEO. So I was considering putting on this trade where I would buy the April 46 calls and sell the May 46 calls. Now, I'm choosing these strikes on purpose. I'm choosing April because that's just the nearest monthly expiration coming up. So we have 33 days expiration. And I chose selling the May. Like, why did I choose May versus these April 30 weeklies or these June options or the August options? And the short answer is, if you notice, and every platform shows this a little bit differently, but in my platform, Tastyworks, you could see on the right-hand side, if I were to maybe just collapse this all down, so it's a little easier to see, you'll notice this little IV score on the right-hand side. This shows you the implied volatility that's being priced into options at each expiration series. And so I'm buying the April ones. You can see they're showing an IV of 95%, right? And I chose the May ones to sell because if you look at the options going this way, 106, May is the highest volatility of the rest of the options on the board. Okay, so that means I'm going to get more premium by selling these calls, right? The premiums and options are being priced by volatility, right? So the higher the volatility, the higher the premium. So to me, that's an edge worth exploiting. So buy the cheap volatility, in this case 95, sell the higher volatility, 106. I know this is a little bit, might be a little bit expert level for some of you guys, and I apologize for that, but don't worry. That's about as expert at level as it gets. Now, here's the thing about the risk reward profile. I'm going to flip you over to my Thinkorswim platform here for a second because I got this built in here. Let me pull up the Analyze. Let me bring up Neo and let's go to the Analyze tab. I got this trade all figured out. So here's what the P&L graph would look like of this trade. Okay. And just to rehash, let me try this for a sec. Let me do a typical calendar spread. This is a typical calendar spread, right? Where you short the near month and buy the long month. This is the profile of a typical calendar spread, what most people put on. In this case, it would cost me $228 to put that on this debit. Ignore this vertical spread up here. This is a different trade that I have on that I'm tracking. We're just paying attention to this bottom one here. But this is what typical calendar spread would look like. It would cost me $228 to get in. That's the most I could lose. So if Neo were to scream lower or scream higher, that's the most I could lose, $228. But you can see here, as long as Neo stays between 39 and 55, approximately, between now and the expiration of the April options, this purple line will start converging to the blue line and my profits will pile up. That's a typical calendar spread. But in this case, we're selling it and it's reversed. Now we got a situation where if the Neo were to sell off or to go up, then we actually make money in the trade. The worst case scenario is that it sits right here, in which case the trade would lose money. But here's how we stack edges in our favor. With a reverse calendar spread, we don't just put it on any old name, on any old stock. We want to put it in on stocks that are showing high implied volatility or relatively high implied volatility. And in Neo right now, the implied volatility is pretty high. Let me go back to Tastyworks for a second. You'll notice here it's got a rank here of 34.2. In fact, I could graph it. Let's go to their graphs here. If I put in neo.ivr, you'll see the implied volatility has spiked in recent weeks right here. So we're kind of up at this elevated level. So what do we know about volatility? Volatility tends to mean revert. So my bet is that Neo, for whatever reason, the volatility spiked a little bit, but once things calm down, this volatility will start to come back down. And when it does, that's going to help this position, okay? If volatility decreases, then what happens is the long or the short options in the back month in May, they're going to lose value a lot faster than the long options in April that I have. And so we win if volatility declines. We also win if the stock has a big move in either direction. I like this trade. I haven't put many of these on. In fact, I don't think I've put any of these on, at least in a long time. But I'm going to play around with this here the next week or so. Might put a few of these trades on in stocks that are displaying some high implied volatility. Now, a caveat with these trades is that these trades do require margin, even though technically your risks are defined as long as you have the long option on in the short, the nearby month. Technically, our risks are defined, right? But the brokerage looks at it differently. And they see that you have naked option. They consider it a naked option in the back month because they're anticipating for whatever reason that you're going to let this April option expire and then you're going to be holding the naked call. That's not the plan here, of course, but that's the way brokerages think. And so they're going to make you post up margin. And so for this particular trade, a one lot, looks like the margin would be about $1,600 to hold that position. So you can't really do these types of trades in size because they do require margin. But these are some really interesting trades that I'm thinking about putting on. And these might be really interesting around earnings as well when implied volatility is high. I'm putting these trades on stocks that have high implied volatility. I'm betting on mean reversion and or betting on a big move either up or down. If anyone out there listening to this has any experience trading reverse calendars, I'd love to chat with you about it, hear about your experience. Because like I said, this is not something I've done myself, but I'm going to start playing around with them this week. I've just been brainstorming about them all weekend. And I think I'm going to pull the trigger on some of these. And this Neo might be one of the first. So that's all I got for you, folks. I hope this was instructional, or I hope you learned something, or hope you got thinking about something. Hope it inspired some ideas. Again, I'm Chicago Sean. Reach out to me on Twitter @Chicago Sean, or leave comments in the YouTube channel here, and happy to engage with you. Trade 'em well, everybody. Take care.